Let's get some perspective from Nicholas Yeo, head of China and Hong Kong equities at Aberdeen Asset Management in Hong Kong. Nick and his team, by the way, manage about $45 billion in Asia-Pac, excluding Japan. They won a range of industry awards for the fund's performance in recent years. Aberdeen Global Chinese Equity Fund returned 66% last year, outperforming its benchmark. Nick, good morning. Just how significant is PPI? Are you looking closely at any of the Chinese data due out this week?
Well, as you know, we are very much a bottom-up house. We focus very much on the companies itself rather than looking out for PPIs or looking out for data coming out from the government. That's how we work.
So if you take a longer-term perspective, what's the biggest risk for China stocks? Fed raising rates, signaling global inflation is picking up, perhaps, or what Paul mentioned earlier, defaulting loans?
Well, what we have here this year is quite a high degree of uncertainties. What you have in the economy is a lot of inflationary pressures. We mentioned earlier on that there could be bubble in the property sector, and the government has to control that in the midst of a deflationary external environment. And we still have concerns on the recovery of the G3 countries, Europe, US, and Japan, and with that, it is quite difficult to really control the bubble in China and not overdoing it. If they overdo it, then the economy could streak to a halt, which is not good for the Chinese economy, because export could well remain quite weak for some time.
Let's zoom in on Chinese equities. Down 10% year to date, down 15% from a 14-month high set back in August. Just a blip or the start of a bear market?
Well, we do feel that there's a lot of uncertainties in the market, and the stocks have gone up a lot, and so they're overdue for a correction. And we are going into a correction right now, and whether this is a blip, I think that there's only certainties when we see more and more of these results coming out later in the year. As far as you can see, the company is still reporting good results, but I mean, who knows? Because of the uncertainties in the economy, we could be due for quite a long correction. But over the longer term, when I say long term, this is 2, 3 years to 5 years. We're still positive on Asian economies, including China. Yeah.
So it could possibly be a deeper correction. What's your take on it? How deep? Is there a way of quantifying it?
Well, it's extremely difficult to quantify it, because on one hand, yes, you have a lot of uncertainties and stocks are overdue for a correction, but the magnitude of the correction is pretty much difficult to predict, because you still have a lot of money sitting by the side. Don't forget, interest rates are remaining quite low. So whenever there's a correction, investors tend to pour in and try to bottom fish or try to buy into some of these stocks on a cheap. So it's quite difficult to really tell you how much the market will correct in the near term.
In terms of opportunity, Nick, some people we talk to are liking banks, property developers in China. Haven't banks seen their best days already? I mean, where's the best entry point if they decide they want to get in?
To us, the best way to play the market is still very much through the Hong Kong companies, which are much more well-run and much more conservative in terms of the way they lend out the loans. So the way that we do it is very much through Hong Kong banks or very much through Hong Kong property companies, because they're much more conservative. I think that is still the way to play. And I think this time around we could see that there could be problems with NPL with the Chinese banks, and this just shows that our stance is relatively correct. I mean, if the NPLs in China do go up rapidly, yeah.
We flashed earlier that one of your top holdings is Swire Pacific, 8.5% allocation, down 12% so far this year. What's in it for this particular company?
This is one of the examples that I mentioned earlier on, that this is a better way to play the Chinese real estate market. As you know, Swire Properties, they do have quite a lot of plans on mainland China. And they are much more conservative when it comes to building their assets in China, and the balance sheet is healthy enough to do that. So if there's any correction in mainland China, then they could capitalize on such opportunities. So this is one of the examples that we have of how to play the Chinese market in a much safer way. Yeah.
Okay, Nick Yeo recommending Swire Pacific. Thank you so much for that.